Welcome to the Nedgroup Investments podcast. I'm Lulama Robertson, and today I'm going to be chatting with Jannie Leach, Head of Core Investments at Nedgroup Investments. Today we're going to be talking about diversification, and specifically diversification within Rand hedges. Hi Jannie, thanks for joining us.
Hi Lulama, thanks for having me.
So firstly, just want to chat about the importance of diversification and how it's discussed within the South African context. What would be the main reasons for an investor wanting to diversify their portfolios, and what are the key character or key components investors should consider when diversifying their portfolios?
So Lulama, I think quite an important starting point for that conversation is to understand the whole concept of home bias. So each of us live within a certain country. That country has its own policy, tax regimes, it's got its own economic challenges or tailwinds. You've got things such as your currency and your interest rates that affects that specific country's economic activity. And by extension, all your other assets and income that is derived within that country. So as a South African, I get my income in South Africa. All my investments are invested in South Africa. So I'm heavily exposed to these sort of like factors within the country. And one of the most effective ways to reduce the specific country risk that all your assets are exposed to is by diversifying into other countries that have different policy, different tax regimes, different interest rate challenges and economic challenges. And so by doing that, I'm not exposed to any given country's specific problems. So for example, in the UK at the moment, you've got Brexit. Some of those decisions have had economic consequences. And so by not putting all your eggs into one basket, you're able to withstand some of that sort of like turmoil that happens from time to time. Now, as I've just illustrated, it's not just a South African problem. Each individual country have their own challenges, which is why what you ideally want to do is to be able to invest in multiple jurisdictions with multiple legal structures and multiple challenges, so that you diversify a lot of those sort of like challenges away. And hopefully over time, what that means is that you've got greater consistency in terms of the outcomes of your versus your long-term return objectives in your investment.
Okay, so you speak about the misnomer of Rand hedges or Rand shares. How does this play out in the South African asset management industry in your mind?
Okay, so Rand hedge shares is basically, it is businesses that derive a lot of their earnings outside of South Africa. Mm-hmm. Now, this is not just a South African phenomena. It's part of globalization. So you've got these big firms like Apple, Microsoft, that actually derive earnings throughout the world. Now, within the South African context, a lot of South African managers that really know the SA shares well have always sort of said that, but Rand hedges could be an alternative to offshore investments. Now, as I've just illustrated, because the real issue is about your home buyers, Rand hedges doesn't really reduce that home buyers risk. You're still dealing with these companies domiciled in South Africa. They are subject to South African law, policies, and all the different challenges that is sort of encapsulated in this specific country. Another aspect around Rand hedges is to understand the context of the opportunity set. So, for example, Rand hedges only make up about 0.2% of the world's equity markets, whereas the other domiciles in the world make up 99.6%. So it's a significantly bigger opportunity set. And then, like I said, you are not subject to the same legal domicile. And so for me, you can't really put those two on par and in terms of talking about Rand hedges as a way to reduce your home buyers risk. It can, however, deal with some of the risk that's associated to the currency. So if you are deriving earnings outside of SA, you can to some extent get some kind of protection against the Rand devaluing or strengthening, given how the earnings work.
So if I'm understanding correctly, while your earnings might be diversified with Rand hedges, because of the limited options in South Africa, you're not adequately diversified.
No, not from a tax and policy risk perspective.
Okay, makes sense. So, Jannie, you're head of the core funds at Nedgroup Investments. And those are some of the most diversified funds in South Africa. I mean, how do you achieve this level of diversification?
So because we don't make any tactical asset allocation or active share selection, we basically have to design our solutions so that they are as diversified as possible across and within asset classes, across currencies, across jurisdictions, because we effectively follow a buy and hold strategy. And you can only really then follow a buy and hold if you have sufficient diversification. So, for example, within our portfolios, we typically hold about 130 SA-listed companies. And on the global side, we hold about 6,000 distributed against all the major markets in the world, including emerging markets. Having other asset classes as well also provides you with some a downside and diversification benefits, which is why we hold about 10 different asset classes in each fund. So those are just equities, listed property, bonds, inflation-linked bonds, and cash, both across SA and across the globe.
That's quite a lot of diversification. I mean, now to show the beneficial effect of achieving it, can you give us some insights into the broad outcomes that investors could expect?
Yeah, so by having broadly diversified portfolios and by keeping your cost low, you end up with portfolios that are very consistent versus their mandate. So if you compare them to their peers, if we look at our core diversified and core guarded funds, they've only been below average on a rolling 1 year period in about 10 to 15% of the rolling 1 year periods, which is very low. I mean, quite often really good active managers will end up at some point in the bottom quartile, whereas these funds have always been just below average in the third quartile. But the majority of the 1 year, 3 year, 5 year, 7 year, longer terms, they're actually in the top quartile. So you've taken a lot of the angst that's associated with relative performance risk that quite often is associated with making big calls in markets, shares, etc., out of it by having a broadly diversified. You don't have big bets in any given share, country, asset class, etc., and therefore you end up with this very consistent investment strategy. It's a little bit, I quite often use the tennis analogy where investments is a little bit like amateur tennis. It's about the person who makes the fewest mistake, not the person who makes the most winners.
I like that analogy. Jannie, thank you so much for joining us today. And appreciate you sharing your insights. It's been really interesting.
Thanks
Looking forward to seeing you in the next podcast.
Sure.
Nedgroup Collective Investments is an authorised collective investments scheme manager in terms of the Collective Investments Schemes Control Act. Nedgroup Investments does not provide advice on financial products and will only give you factual information. For further details on our funds and to view our terms and conditions, please visit nedgroupinvestments.co.za. Nedgroup Investments, see money differently.